Hello, I'm Robert and welcome to my channel, where I talk about everything automated algorithmic trading, or simply algo trading. The last couple of days I've been working on an experiment that takes advantage of something that traditional grids do automatically at the start, and that is they preload all of the grids below a certain point for automatic purchases. I've taken this theory and applied it to a different context, where as you start a new grid, it purchases all of the levels at once. And as you can see, that turns out to be a clustered mess. But the reasoning behind this is very simple. And that is, if the market goes in your favor, it will sell off that entire cluster in one huge blow. If the market goes against you, the normal grid theory takes over and you sell off the oldest entry to make the newest purchase. So in essence, you are getting a slight edge of the market, because if it does go in your favor when you made that large amount of purchases, it can really be a game changer. How much is actually quite surprising, as I ran the experiment over the last 24 hours and the results are quite shocking, to be honest. Something I really didn't expect in terms of the benefit of the direction the market went. But as always, everything revolves around understanding risk, and whether or not this technique is worth the risk is something only you can decide for yourself. Right now we're looking at one of the pairs that did extremely well. It sold off 1.5 times the total grid levels. So basically, within a very short period of time, it made 61 sells. All of them in profit, and it really took the balance of the account to a shocking level. So as we look at the market, we got in just right and it did exceptionally well. Now let's take a look at an asset that didn't do exceptionally well. In fact, it actually did very poorly. Well, Australian US dollar did wonderful and really took off. The euro franc did completely the opposite and took several stop losses right away. But because of the cluster being so close, rather than taking several stop losses at 400 plus pips, those stop losses were relatively small, comparatively speaking. So in the long run, it will make back its losses very quickly. But it's still something that you must factor into your risks, because it can go bad very fast, as we will see when we get to the actual numbers in the VPS. So here we have the worst case situation that counters the best case situation of Australian US dollar. So now let's get into the VPS and actually look at the whole process mechanically. Now that we are in the VPS and looking at the Australian US dollar log, let's get down to the nitty-gritty details, go to the bottom of it, and let's go to where I actually implemented this. Here is the previous way of one position at a time, slow growing, meaning it does not cluster up or make a large number of purchases. But here I've done the preloading effect, where you can see where I've actually bought 43 levels. Now these are all clustered together, as you can see by the prices on the screen. The risk here is what we saw in Euro franc, that the market is just going to go against you hard and you're going to take some losses. But for the Australian dollar, it was at the right place at the right time, and we have a complete wall of cells where it just literally sold off the entire cluster. This just took a jaw-dropping effect on the profits. It really took this account to a whole different level. And you can see the level of profits we are getting for this particular account. So once it's sold everything off, it goes back into another preload. And we can see here another 43 purchases. And it starts another sell-off. Now this one did not sell off the entire grid. It only sold off about 21 positions. But still, you're looking at about 61, 62 total positions back to back being sold off. This was a staggering, in the right place at the right time situation, and it just really took the trades to a whole different level. So as we see the sell-off, and we see right now we're still in the sell-off, so we may end up with more along the way. We may end up with 3 or 4 sell-offs at the rate the market is moving. That is a best case scenario. But for this best case scenario, let's look at the worst case scenario. The worst case scenario, Euro franc. Here we are with the normal trading approach, and then I activated the preloading approach. And you can see it begins building a wall of purchases. And then we go right into the brutality of just what happens when this thing can go wrong. Stop losses right away. The only saving grace here is that these stop losses aren't as severe as they would be at the end of the grid 400 pips later. So that's kind of a counterbalance to having this approach. But as we can see from the comparison of Australian US dollar versus Euro franc, the risks are very real and very catastrophic. Now let's look at the actual numbers in terms of just how they affect the bottom line, how they affect your equity. Okay, looking at the equity, the profit per month. Blueberry Cobbler has always been a slow approach to begin with, but we can see the impact already. $52 for the entire month of January, and yet because of one 24-hour period of being at the right place at the right time, we are already up to $70 for this month only. So the preload impact can be drastic, and it can be quite powerful when the market moves in your direction. Now, when the market doesn't move in your direction, it can be equally as vicious, although it's not going to be the magnitude of the full extent of the grid biting you. Nonetheless, you are still going to take some losses that you need to be aware of. Now, can this market change? Yes, it can, and that's the point of the preload. The back and forth motion trying to take advantage of opportunity when it's given to you. It's not a perfect situation, and there are cases where you could be in the right place at the right time and walk away with a jaw-dropping surprise, or you can be in the wrong place and in the wrong time and just get hammered. There's no way of knowing which way the market is going to go, and this process does not try to predict it. It simply moves with it. That is the long-term stability of what this technique does. If a market moves in your favor, it can really be astounding. If the market doesn't move in your favor, it can be vicious and painful. from the standpoint of your overall technique, everything revolves around risk. The preloading technique does require you to be spot on with your budget, because if you don't make your numbers accurate and correct, you will go right into a margin call, because you are maximizing the totality of your budget at one time. Whereas using a traditional approach that I've demonstrated previously, with one level at a time, there's some flexibility to make corrections. Not a lot, but some. This is why testing is absolutely critical. Now, the one thing I want to add to this that is important, and you already know it if you've been following my Patreon, and that is negative finance rates or soft staking. One of the things that you need to be aware of is that if you can put yourself on the side of gaining finance rates on your account just for holding the position, then preloading is even more tastier, because that means you're getting interest on your position just for holding it. Now, that does not happen all the time, and in some cases, some pairs just don't give negative finance rates at all. So you have to do your research and know which ones do. I've posted information on my Patreon, link in the description, where I show the example of 1 day's worth of finance rates for this account. It's not that difficult to see that just how using simple techniques like this can help you in the long run, if you understand your risks. That is the most critical component of everything. You must be able to have a clear and set consensus of what your risks are, what they are going to be, and exactly how things work out. For example, we can see with my demo accounts, I have full saturation and I have full NAV on a lot of these accounts. As we see them roll in now, you can see just exactly how it plays in, how much got sold off at given times, how much is still in play. This really demonstrates and reiterates the critical importance of using demo accounts, because you can use this information as a part of your trading approach for your live money account. Preloading is an interesting technique that, if you have the risk for it and have the budget properly calculated, it can do well, because you can see here a NAV of 610 versus a NAV of 300. You're looking at the case of where your margin rates and leverage levels per asset affect how much money you have at risk. So you must do your research carefully. But once you have done that, you can begin to see just how much this whole process can benefit you if you have the right market conditions. In the long-term process, this will help a position, but you must have the budget up front to think about the worst-case situation. If you don't have enough budget to really weigh out the worst-case situation right away, it is not something you should use. Wait. You can always turn it on later and let it take care of itself as the market progresses. Do not make the mistake of getting too greedy, or it will wreck you right away. So, be sure to subscribe to my Patreon to get all my inside details, where I talk about a lot of this very clearly, where I show examples of it. Like this video so that other people can gain this information and help them grow in their trading. Leave me a comment. Let me know what you think. Let me know how something like this would affect your risks and abilities in trading. I'm interested in seeing different prospects and possibilities based upon certain pairs. Thank you for watching, and until next time.